Hello, everyone. My name is Matthew Castricone. I'm the director of the enterprise side of the Stellar ecosystem. The enterprise side is the companies who are building on the Stellar network today. This set of companies includes asset issuers, infrastructure applications, all the way to wallets, market makers, as well as the local fiat on and off ramps in each country. Today, I'm very pleased to be joined by 4 industry vets who come from payments and crypto companies, which are currently building on the Stellar network. Amit from Finclusive, Ruben and Lisa from Airtm, and Santiago from Bitso. Can everyone please introduce yourselves and explain a bit about your organization, starting with Amit?
Hi, thanks very much, Matt. And it's great to be part of this panel. It's great to be part of the Meridian conference. Stellar just does a fantastic job, and I want to thank you and the hosts in putting this together. Finclusive is an anchor on the Stellar network. We are a hybrid fintech, regtech platform. We provide a full service financial crimes compliance, AML, KYC, KYB stack that enables other fintech companies, other anchors on the Stellar network to have a standardized compliance capability across the globe. And we're on on-off ramp in the US, connecting to US fiat banking so that we can facilitate cross-border payments between issued assets, transacted assets on Stellar into the US fiat banking system. And by combining the two, we can create transparency, auditability, and all of the elements that are required from a risk and governance perspective, but do so by really enabling and taking advantage of the great technology that Stellar brings to bear in providing much more inclusive opportunities with a compliance-centric mind.
Thank you, Amit.
Should we jump in?
Yes, please.
Okay, I'll go next.
Thanks, Lisa.
My patience, I'm always the least patient. So hi, my name is Lisa Nestor, and I am also super happy to be here today. So thank you, Matthew. And as always, thanks to the wonderful SDF for organizing. As mentioned, I'm currently a strategy consultant and working closely with Ruben and his team over at Airtm, which has been an amazing opportunity so far. Prior to that, I was a very happy member of the Stellar Development Foundation team, where I worked for a little over 5 years. So there I started supporting partnerships and then eventually rolled over to the enterprise ecosystem, which was an incredible experience to work with a wide range of companies, from small startups to much larger enterprises, and supporting them and integrating Stellar and kind of thinking about their growth path now that they've entered into the digital asset ecosystem. So yeah, pleased to be here today and excited to participate in the discussion.
We're excited to have you.
Matthew, I can jump in as we can box all of Airtm into a set of back-to-back presentations. My name is Ruben Galindo. I'm one of the founders of Airtm. Right now, I'm Airtm CEO. And it's great to be here. We have been working closely with Stellar for about 6 months now, and we have tracking each other's progress for quite some time. And it's been amazing to see the development of the Stellar network over the last few years, as we have as an ecosystem pushed for more fair and freer access to financial services around the world. And working at different parts of the stack, it's very evident how we're all super important. We at Airtm specialize in giving people access to blockchain dollar accounts. And anywhere you see Airtm's pitch to clients, you won't see blockchain, because we try to make it all very easy for our users. And our partnership with Stellar will make it such that we will not just give access to dollars to people, but better access to not just dollars, but the Stellar ecosystem and all the infrastructure it's building. And I'm very excited to talk about what we think is going to happen during the next year. So thanks for having us.
Thank you, Ruben. Santiago?
Hello. So I'm Santiago Alvarado. I'm Senior Vice President of Product at Bitso, currently leading our institutional division. Bitso is a leading exchange in Latin America. We have 3.3 million users, We're end-to-end regulated and are focusing on expanding our footprint across Latin America. Currently, we have operations in Mexico, which is still our biggest market, but we have a significant and growing operation in Argentina and Brazil, and are about to launch in Colombia.
Great. Thank you, everyone. I really appreciate everyone being here today. And, you know, I look forward to a lively debate. So we're going to dive right in. Everyone ready? Okay. So we've all seen the headlines. We all watch the news. Regulation in crypto is heating up. Amit, you have some expertise, some experience in this area. So I would love to hear your predictions for regulatory action in 2022.
Absolutely. So, as most folks know, I'm a former regulator. I spent some time at the U.S. Treasury Department, the Office of Terrorism and Financial Intelligence, OFAC, FinCEN came under that purview. Our team has a number of ex-regulators as well, former Fed, and the like. I am quite, optimistic about the regulatory landscape into crypto. I think the fervor and interest has only grown, and that's a good thing. While some folks see that as potentially harmful, I think you need regulators on your side to understand, number one, that crypto decentralized financial services has left the station, right? That is a reality today that is growing. And regulators and policymakers, I think, a year and a half, 2 years ago and prior were more resistant and or thought about the space as the Wild West, as completely unregulated, a number of folks that did not care about risk, governance, compliance, transparency. And I think the last year and a half in particular has shown that many in the sector really care about it and are developing innovative solutions. So I believe that interest and growth has comported with the growth in just the propagation of new assets, stable coins, alternative coins, the growth in central authorities like central banks, increasingly engage in central bank digital currency projects. The market capitalization of digital assets continues to grow into the trillions and beyond. So that train not only having left the station actually is a very good thing, because from my standpoint, from a 2022 and beyond, I think we're going to see a couple of things. One, we're going to see much more sector-driven guidance to the policymakers, to the regulators, because the policymakers and regulators, I believe, increasingly are seeing that they need a lot of learnings around the underlying attributes of blockchain technology and the capabilities that it affords, both in terms of driving inclusion, but also insofar as creating viable ways to address the intents of financial system regulation, which is consumer protection, safety and soundness. The ability to actually protect people and their assets is key, and there's a lot of underlying technology capabilities that blockchain affords in doing so. The second prediction I would make is that anyone can build on blockchains, as we've seen, and certainly the last day and a half have shown that. And that means regulators have to get out of the boxes that they have traditionally been in terms of what certain financial intermediary types are. Are you a money service business? Are you a deposit institution? Are you a securities company? Are you an investment bank? Are you an asset manager? Are you an insurance provider? And I think more and more we are going to, it doesn't matter what kind of organization you are, and therefore what regulatory blueprint you might fall. It's really what activities and practices are you taking? And we're seeing that reverb across the board, US regulators and overseas regulators and the global standard setters for risk management, anti-money laundering, is, are you issuing value? Are you storing value? Are you transacting or providing liquidity, regardless of what kind of entity you are? And that, I believe, these activities and practices approach continues to gain much more resonance. The third trend is privacy. And that has been exacerbated in terms of importance over the course of the pandemic, access to personal sensitive information. And we now have capabilities to preserve privacy as well as provide engagement. And that is exciting because more and more, whether it's digital compliance credentials for identity management or streamlining the know your customer or know your business process, these are all hugely important to global regulators. And finally, I will say that we don't have a single regulatory conversation that does not include inclusion, right? It is top of mind of a lot of regulators. And how do we ensure access safely and soundly to financial services in whatever shape or form they may comport. And I think the innovation of that space from the standpoint of driving inclusion is being seen in these blockchain-enabled technologies and payment systems, and that's exciting. So I think that 2022 and beyond, we'll see greater growth in that space in a positive way, and that's not going to be without its hurdles and its bumps in the road. There's going to be plenty of that, but I tend to be fairly optimistic about it.
So I appreciate your perspective, especially given that you came from the regulatory agencies that are kind of looking at all of this. Lisa, I know you have some thoughts on this issue, and I'd love to hear a rejoinder.
Sure. Yeah. I mean, I definitely appreciate Amit's rosy colored glasses when looking at the regulatory landscape. And, I do think that in parts of the world, that's going to be right. I definitely think that though we're certainly seeing some fumbles here in the US, there's overall a very clear desire to create more transparency, certainty, general, just understanding of the space and regulatory environment. Just this month, having the US Treasury publish a report on stablecoins, like really signaling to the market, an intent around this technology. That being said, the US is one place in the world. And, my predictions is that we're going to see a lot of negative reactions toward this technology in other jurisdictions. And it is going to be challenging for the industry. I think this technology moves very quickly. And I think though oftentimes the motivation behind things like, blanket bans, there we go, blanket bans of cryptocurrency in a market, to say, again, consumer protection, I think is often kind of what we hear regulators pointing to as kind of cause for those types of things. But I think it's also very new. A lot of this stuff touches the core of economies and financial systems, and it is moving incredibly fast. And so I think we're going to continue to see knee-jerk reactions from regulators. I certainly hope that kind of the opposite sides and opposite reactions will, facilitate some middle ground where we can see more kind of global or multilateral discussions around this technology and what does consumer protection mean, like what are token taxonomies that we can all get around. But I expect to see a lot of rocky seas in many markets in 2022.
Yeah, thank you, Lisa. We all, at least my team we watched the press release in the news about the current ban du jour happening in India. It seems new regulatory guidance comes out in India every 6 months or so. So I definitely share your perspective in terms of some rocky seas. However, we have some experts in LATAM, Ruben and Lisa as well. And I'd be curious to hear your perspectives on kind of what's going on in Latin American markets vis-a-vis the United States. For example, I know that Mexico in many ways is very forward thinking in some of their thinking about crypto. And I always love to hear if you have any thoughts on this.
Sure. Like Lisa said, and like you share, there are rough seas ahead for any companies or organizations trying to do things in a new way. And, the case in Mexico was, you have a very nice way of saying it or describing the reason why our regulation was put in place so quickly. I'm not sure it was because regulators were necessarily looking to create a very straightforward way for Mexican entrepreneurs to navigate the new landscape and to come into the very highly regulated banking and financial service industry. But you could say that the way the regulation was applied made it a bit more difficult for entrepreneurs to kind of embark on this experience. And they, in some ways, and as it pertains to crypto, did certain things without first understanding. And it's difficult to blame, right? Because on one side, you see how things could go astray for the Mexican economy if there's open access to any type of currency, for instance. And therefore, you'd have incentives as a regulator to kind of make sure people are doing things or business are doing things in ways that are not going to lead to a big chaos. But at the same time, you could argue that 3 years ago, when the regulation was drafted, the ecosystem was not developed to the point where they could see and understand how it all was going to shape up. If they were to draft regulation today, it'd be probably very different, right? And luckily, rather than going to the extent of creating a new law, other nations have taken the sandbox approach, which is it's novel and it's friendlier for innovation. In Mexico, there was a sandbox, but barely any new company applied for the sandbox kind of regulation or model because, it was a bit uncertain. And presumably the activities which we were all doing, as Amit said, were already activities that were being facilitated by other regular financial institutions. And so you could have, for instance, for Airtm, it was evident that we could, under the new framework, operate, and things shifted a bit. And another thing that's important to understand is that throughout the developing world, there's big companies that leverage regulation as moats to their market share, right? And therefore, local regulators and business owners have, a bit of a say in how regulation is shaped and what, therefore, we as entrepreneurs can do. Hopefully, the decentralized nature of the industry will make it difficult for these moats to continue being had, and for regulators to just try to do their best effort to open up better access to financial services for their people.
Well, thank you, everyone. I appreciate the lively debate, appreciate the back and forth. I think it's going to be an interesting thing to watch, not only in this country, but in all the countries. I mean, it seems like every week there's new news out of China as well. So in the interest of time, let's move forward to the next prompt. And this is a slightly different issue, but in some ways, a corollary one. What liquidity gaps do we see across payments and crypto today? Santiago, coming from a leading digital asset exchange, do you have any thoughts here? I don't know. Did we lost Santiago? And that's okay. Lisa, you have a lot of experience in liquidity coming from SDF and working with Airtm. Do you have any thoughts about gaps in liquidity in payments and crypto?
Yeah, I mean, talk about moats. I think we are making a ton of progress as an industry. Moving from liquidity that's really tied towards trading to liquidity that still supports trading, but with use cases, really layered in there. And so, yeah, I think we, the things that have been really exciting to me in the last 2 to 3 years in terms of the progress we've made in liquidity have been really tying together, local fiat rails to the digital asset ecosystem. This is an area where, Stellar really focuses. I heard on the last panel, Mary talking about this right before we joined. And, I couldn't agree more that making sure that we're connecting legacy financial infrastructure to the new digital asset ecosystem, creates that front door entryway. And, continuing to invest in that so that we create really seamless on and off ramps, because, as Ruben and I often talk about, you can't convince people to stay in the digital asset ecosystem if they don't believe they can get out the door, right? So like you have to develop that trust. You have to create very seamless experiences for cashing in and cashing out to kind of build that trust with your end user to be able to convince them that they can really start holding, spending, saving, doing all these other things in digital assets. So I think that can continue to grow. When I mentioned moat, I think the big gap we have right now is continuing to source capital to support the liquidity that we want. And in this regard, I do think that kind of like the wild, like the kind of newbie innovation that we have that brings me a lot of excitement is DeFi, and its ability to provide very interesting ways for individuals and businesses to contribute capital that can be used efficiently within these ecosystems. So, if I am an individual and I, have a stable coin, in Filipino pesos, and I want to somehow now, earn some yield on that, like how can we start breaking down the barriers to, me putting my capital in a secure financial instrument that can then be utilized by a business or a financial institution more directly to support the clearing of my payment, right? Right now, this is very kind of siloed. And as an individual, there's a lot of intermediaries who take profits or revenues from utilizing my capital in productive ways. And I think DeFi is giving us an opportunity to kind of create a direct path. And that's important because I think that individuals are much more interested in kind of taking the risk and putting their capital into this environment. I think we are in an economy right now where people are hugely yield seeking, especially in the West. And so if you can kind of create this path for direct capital contribution that eliminates so many of the intermediaries, then I think we'll see some really interesting things happening around providing more capital so that, again, the kind of digital asset ecosystem can benefit from having, smoother transactions, less slippage, less spread, and the types of cross-asset, trades or transfers we're trying to do. So I think capital is a big liquidity gap, but I'm also excited about DeFi as a path forward to kind of filling that gap.
Yeah,
Matthew.
Yes, sir.
Oh, sorry.
Please.
Just to add to what Lisa said, I think it's very beneficial that these liquidity gaps are being filled by companies looking to meet local consumer demand for access to crypto trading. And you have a very big economic incentive for all the local exchanges who want to make money by giving people access at a local level to trade cryptocurrencies by bridging these gaps. And as just a regular marketplace perspective, this way of seeding the beginning or I guess the ecosystem will make it such that eventually, or for companies that are aiming to provide more traditional financial services like money transfer, like Airtm, will have, an easier time rather than if we had begun our fight 10 years ago or 5 years ago, where this liquidity gaps were so wide, where being able to run a business on top of this infrastructure by helping or by leveraging it to use or to help someone move money from one country to another would have been impossible. And given Coinbase's IPO, it's easy to assume that Bitso will be able to get more money to acquire more local consumers to continue bridging that gap, and even to build more, just to expand into more countries and creating that, I guess, anchor, if you will, infrastructure at a local level with sufficient liquidity so that tomorrow another version of Airtm or even Airtm could leverage a more liquid market in more places. But it was initially because of people looking to trade money or cryptocurrencies, and companies like Bitso creating the infrastructure and liquidity to provide that.
You know, it's interesting as just taking a step back, kind of as a payments person. First of all, on the capital kind of availability impacting liquidity, I would agree with this. I mean, one of the promises of blockchain and crypto is, I believe, on a daily basis, there's something like $4 trillion locked up in Nostro Vostro accounts all over the world, pre-positioned there simply to keep that liquidity path open. So in my perspective, one of the promises of not just Stellar, but blockchain and cryptos in general is freeing up this capital that's locked in these Nostro Vostro relationships and redeploying it around the world to be used in a more economically efficient manner, which should result in financial inclusion. So I think about that. The other thing I think about, the kind of converse to that, is that I think that currency, the FX market, is the largest global market in the world. I think something like $6.5 trillion in FX is traded every day. I think it's by far the largest market in the world. And the fact of the matter is some currency crosses work very well. They're very efficient. The banks know what they're doing. Big, large interbank payments, repositioning. I mean, if you're a corporate and you call up your bank and you want to sell $5 million USD and buy MXN, you're going to get good pricing. But again, it probably comes with the caveat of that Nostro Vostro lockup. But as I think about liquidity and capital and things like this, in your perspective, based on you're on the ground, you're working on this every day, what needs to happen with crypto liquidity, with the fiat on and off ramps, to even come close to approximating some of the efficiencies we have with major, USD Euro cross, for example? What things need to happen to make it more efficient, like that efficient market? And I know that you're involved in liquidity every day.
Yep.
I wonder if you have any thoughts here.
Yeah, there's a couple quick things here, and it actually gets back to the original question as well. And I appreciate very much Lisa's points and agree. There's going to be a lot of bumps in the road, especially when there are differing incentives from a overarching kind of regulatory oversight perspective. Liquidity is one of them, right? Where do we find pools of liquidity to do fill in the blank, whether it's trading, payments, real-time settlements, etc. I take one example, right? At least from our standpoint, when you think about inclusion, right? From the cross-border remittance perspective, right? If you're looking at 400 to 500 billion, yearly in just outbound flows from the U.S. to the emerging markets, that's 4 times foreign aid. And in the next year, it's going to eclipse foreign aid and foreign direct investment combined. In the next 3 years, foreign aid, direct investment, and capital markets transactions combined. Just the income economy. And more are gravitating to digital assets to do so because of settlement times, efficiencies, etc. So when I think about liquidity there, I think on and off ramps are key. Can I actually depend on a reliable network that will off ramp a payment to a beneficiary in real time? Or am I going to have a network problem because I can't get that off ramp to connect to me? That has real world today implications, both with respect to the consumer or the corporate, as well as liquidity broadly from an inclusion perspective, right? So how do we quote unquote mandate in a decentralized world, right? How do we create standardization? Liquidity is also being chased across networks, right? There are a number of different networks that, for example, stable coins like USDC are traded and transacted. Now, do I go across the Stellar network? Do I go ERC? Do I go across Solana? Do I go across Algorand? Do I go direct? Do I go peer-to-peer? And that chasing liquidity is going to be, where's the path of least resistance? And the ability, therefore, to go from that stable coin to actually meet the everyday need, like Ruben and Lisa were talking about. So from the standpoint of sort of the liquidity, I believe that it's going to chase those efficiencies, those sort of real-time needs, until and unless full virtual assets are entirely ubiquitous, which they're not. Which gets back to the other question too, which is in the near and intermediate term, you have to have efficient on and off ramps to get engaged with a virtual asset transaction, whether it's trading purposes or payments purposes, to the ACH rails, to the wire rails, etc., so that I can actually pull out local currency. And that, I believe, is where it's a bit top of mind from an inclusion perspective. And that's where standardization and interoperability actually lends to the liquidity challenge.
Yeah, I totally agree with that. And then you start to say, well, where do those on and off ramps source their capital, right? So they can really ensure that. And so, I went super DeFi to begin with, but I'll swing back the other way. I think part of this too is just this kind of slow supply chain migration, right? And we kind of have created this new settlement system, asset class, an ecosystem. And now we just kind of need to slowly start porting, some legacy kind of infrastructure from the old system into our new system. So, part of that is like, can our on and off ramps, and we've certainly talked about this before, Matthew, like, how do we make it easier for them to borrow? Like, how do we start, pulling in capital sources, more legacy capital sources, and showing them that, putting capital into these ecosystems can have return, and creating, mutually beneficial relationships all the way up the supply chain from, I'm the wallet that's, holding the digital assets, I'm the on and off ramp, that's helping to facilitate to, I'm maybe a more traditional financial institution who's providing capital and, FX desks and FX market access to help support, this industry's kind of movement of funds. So, I think we have a lot to do and kind of building those relationships out. And, I think nobody's going to come to the game if they don't think that there's, some food onto the table for them. I guess I probably should say dinner, not game. So, I think we also have to prove that there is real revenue opportunity here. But I do see that as being part of the equation too.
Yeah, I love this topic about liquidity, because it intersects kind of everything we're talking about, like capital, regulation. I think Danelle from the CEO of SDF has even talked about, without liquidity, a lot of the use cases don't drive. So it's a fascinating topic, one which I'm sure we'll debate in full moving forward. But in the interest of time, I think we're going to move on to our last question. And Ruben, I'll start with you. And this one is our contrarian kind of area of our debate. So two questions, starting with Ruben. Are cryptocurrencies in a bubble today? And what do we think will happen during the next economic downturn? On the spot.
Yeah, it's difficult to say that they're not in a bubble, because everyone who's bought into cryptocurrencies does not have a fundamental level understanding or assessment of why they bought that cryptocurrency, right? If you could argue against that, then maybe you'd say, okay, we're not in a bubble. A lot of people are in it because they want to make money. And, I think it's very cool that we are able to slowly transition, and getting back to the liquidity question, to a use case that's actually driven by solving someone's problem, right? And I guess the issue is, and I'm afraid for building on top of the current crypto exchanges rails, because what happens if you come to rely on them and then from one day to the next their liquidity ends, right? And you were counting on them to be able to deliver money to your clients. And as Lisa said, it's going to be a slow transition. And luckily, big banks giving cross-border services to small retail consumers are making so much money off of that, where it's a lot of margin to play for us, and to bridge the gap that there is in this lack of liquidity. But I am afraid of the crypto bubble bursting, and a lot of the infrastructure that's aspiring to be built on this infrastructure to be impacted by the pop or a long crypto winter.
Yeah, it's interesting. I would probably agree that we're in some sort of bubble, but taking a kind of a step higher, I believe that there's a bubble in a lot of assets, not just crypto. I mean, real estate assets, equity assets, a lot of commentary that these are all kind of in inflated prices now. But yeah, it's an interesting question. I was wondering, Amit, you were shaking your head, nodding your head. I believe you have some thoughts on this.
Yeah, plenty. Ruben made a lot of good, insightful comments. There's one in particular that's worth reinforcing. What bubble are we talking about when you get down to a specific use case, right? And that's why I brought up the sort of payments and sort of remittance piece, right? From an inclusion perspective, like there are plenty of folks in the crypto universe that are entirely profit seeking to try and take advantage of both arbitrage opportunities, the lack of liquidity in certain asset types to do pairs that will spike their own margins that have very little economic value outside of their pocketbook. That is happening in droves. And that's what the capital markets do, right? They innovate in ways that can find extractive value in these different innovative asset types, right? The modern derivatives market, how that whole financial collapse happened in terms of financial innovation in the last larger bubble crisis. But you're right, we're seeing these asset bubbles in a number of different spaces. And I would go back to, how do we look at explicit and specific use cases where bubbles may be forming that actually impact real lives? If, for example, the day-to-day application for me to just send a couple $100 to a family member that needs a medical treatment in a foreign market, and I can do so instantaneously, I want to work in an asset that will preserve value at both the on and off ramp and has stable value. I don't want to be trading, and I don't care about liquidity in esoteric assets that have a lot of market volatility. If I want to start a small business, and the fastest way I can do that is by going to a digital asset lender and do so to get $1,000, $2,000 to just start my new business, I'm going to go to where I get the biggest value and the cheapest form of that capital, right? If I want to attract yield because my local banking is giving me 0 or next to 0%, but I can actually hold value in a higher yielding savings instrument, I'm going to gravitate there. And so I think we have to look at those bubbles that impact real lives. And that should be driving the inclusion piece. And again, it gets back to the second topic and the first topic of kind of how do we formulate an incentivized governance structure that brings transparency and protection and safety in ways that really take advantage of what the crypto universe really has to offer. And that's what I'm hopeful for. That's what I'm long on. Again, it's just a nicer existence to be glass half full versus glass half empty. So I tend to take that more positive view. But I mean, I get very jazzed working with Ruben, Lisa, and folks at Airtm on the power that bringing digital dollar accounts to anyone so that you can create stability and a mechanism for the transfer of value for everyday needs. That's core. I'm less concerned or interested in how do I provide extractive value to take advantage of different currency pairs because there's a lack of information between different crypto assets, right? So that's the excitement that I have. And I think that from a regulatory perspective and a liquidity perspective, as we think about this bubble, I think we should think about where are the real bubbles and what can we do to mitigate those when they are about real life use cases and building economic resilience.
So thank you for that. It's interesting. I think in the past, we always heard that cryptocurrencies were decoupled from other markets, decoupled from the equity markets. It was counterinflationary, et cetera. And I believe that thinking started changing around 2000, about 2 years ago, where now that institutional money is flowing into crypto and the use cases are expanding, there's some current commentary that cryptocurrencies may not be decoupled either positively or negatively, but correlated in some way with other financial markets like equities. And when I think about, this concept of what happens during the next economic downturn, if we're in a bubble today, what's going to happen? I think there's going to be some new thinking about this because I don't think it's an automatic assumption anymore that cryptos are decoupled from other financial markets and are counterinflationary. I think it's very murky now. So Lisa, please.
Oh, I was just going to say, yes, I agree with that. I would say, I agree with Amit's comment that like overall, it feels like we're in a fairly heated market. It's also just been, there's been a lot of things changing in the world in the past 2 years. But yeah, I agree. I think we're seeing much more correlation. And the truth of the matter is, the crypto market is probably one of the most risky markets out there. And when economic downturn happens, you move out of your risky asset class. So I do think that when it hits, it's going to hit hard. But as somebody who's been in the industry for a couple of years, I'll say, some of the slowdowns in crypto have been the best times. And, it's when you kind of are able to see what's really valuable and what's just foam on the surface that's being really choppy. So I think that there is a ton of evidence. And I looked up a couple of things, and that's what I wanted to mention. The IMF estimates that over 110 countries are in some active stage of CBDC development right now. The US Treasury publishing this month a report on stablecoins, proactively planning for them to exist in the market. This isn't something that is a fad, it's very real. And I think a last data point that I was really excited about, to Amit's point, is Chainalysis released a report earlier this year, just looking at crypto transactions and specifically remittance payments. And if you compare transactions of $1,000 or less that are remittance payments to Africa, since 2019 to 2021, we've seen a 3x increase in that moving forward. And, so what does that look like? 150, 200 million annually in a $40 billion industry. So we're not knocking anything out of the park yet, but we are seeing in a very hard to play space, real growth in the utilization of this technology to execute those payments. And for me, that's super exciting. So like absolutely on the surface, there's speculation, it's a little bubbly, but like an iceberg, I think there's just so much real value under the surface. And once things calm down, that becomes very evident. And that's, I think, exciting.
No, I agree.
Just to add to that, sorry, Matt, but the reason why liquidity is so important at a local level for financial inclusion is to be able to deliver a good remittance, right? And speed and cost. But what happens if people don't want to cash out? What happens if people can just stay with the USDC they receive? What happens if they start telling their family and friends that, hey, I can pay you in USDC or an Airtm, right? Then liquidity maybe becomes less of a problem. And at the end, a consumer is not looking at liquidity. They're looking at how much money they sent and how much they're able to cash out. And if they notice, and consumers are smart, we're smart as people, that they could keep 10% more money if they don't cash out, but rather convince their landlord of receiving $1 payment for rent, then maybe the need for that liquidity is diminished, or it is. Not maybe, it just totally is. And I think that will have a big impact in, I guess, the way we value liquidity in the future, because it won't necessarily be needed. What it looks for Airtm to be successful, for everyone just to be on the US dollar economy via USDC or some other stable coin. And that implies that, we don't need local financial systems necessarily as Latin Americans. And that is true value. If we're able to shift that paradigm, we are generating true value today to people, right, in the ground. And so no matter what happens in the next few years, as Airtm grew during, I guess, the first crypto winter, it will continue to grow because remittances will continue being expensive. And if we can continue giving these retail financial services in a better way, solving the same problems that we've been trying to solve for 30, 40, 50 years, 100 years, then, there's a lot of people will benefit, and that any crypto winter bubble burst won't really impact that.
It's an interesting debate, and the reason I like is it intersects against policy and liquidity and use cases, to Amit's point. So back to, I would say, kind of a corollary question, kind of, hot off the presses. as it were, and it relates to some of the things we've been talking about consistent with LATAM and hyperinflation. There's been a lot of press recently in the US about the top line inflation number at 6+%. Inflation is, people were saying, yeah, the US solved inflation for 20 years. Well, that thinking is currently being questioned. So real quick, kind of quick Q&A, is inflation a positive or negative for cryptocurrencies? Tough.
Ooh, yeah, I'll say positive. If people are chasing yield, I think we'll have more attention. That's my hot take.
Although, could you say that it's because of inflation that crypto is doing so well, right? Is it because everyone in America has so much access to cheap capital, or free sometimes, that the price of Bitcoin and its limited supply, that Bitcoin is worth so much?
Yeah, even Mark Cuban has talked recently about, he believes that one of the reasons the unemployment number is at the level it is in the US is a lot of younger consumers are buying Bitcoin and getting yield on, crypto assets instead of going out and looking for a job. And that, if that's true, that creates inflationary pressure.
Dogecoin has had way bigger yield.
The direction is important. The direction is important. I think that's a very, very important statement. And also, I would just like, people need to unpack what's in the inflation number, right? We take a lot of real economy stuff out of that number. And so we have to really understand what inflation is. I mean, gas prices have been going up pretty consistently over the last couple of years. And do they really constitute what's in that inflation number? And the other piece of this too is, again, at the end of the day, we're chasing a way to hold value securely, right? That it maintains that value securely, and that I can transact in that value where the counterparties can understand and receive that value. That's what we care about. So does that mean everyone go to Bitcoin? Right. But does it mean going to stablecoin to actually effectuate those payments? Maybe, right? So I think that the direction of that causality is really important. I think the advent of more digital assets in their numerous forms give us opportunities to hedge against inflation, as well as maybe also see where there could be detriments to our again, real economy pieces.
Well, we're at time. This has been an awesome discussion, a lot of fun. I've learned a lot, and that's always a good experience for me. So I would like to thank Lisa, Ruben, and Amit for joining us today. And with that, I will turn it back over to Justin. Thank you, everyone.